The cash rate. You might have heard about it, usually referenced by economists, journalists, or people at parties who want to seem like they're really financially switched on. But what is it, and how does it affect you and your home loan? The cash rate is not when you pay a tradie in cash. It's the interest rate that banks and lenders pay on money that they borrow to balance their books. This rate is set by the Reserve Bank of Australia. Before we understand more about the cash rate, let's understand these Reserve Bank people and work out what business they have in tightening our purse strings. The Reserve Bank of Australia, or RBA for short, is Australia's central bank and was created in 1960 to manage Australia's currency and economy. They have a literal license to print money and put in place policies that keep Australian money, jobs, and economic prosperity ticking. They also have a pretty snazzy building in Sydney. Good on you, RBA. The RBA meets 8 times a year to talk policy, catch up on their weekends, and possibly change the cash rate. Why do they change it? There are quite a few factors. A big one is inflation. Inflation is an increase in prices and a fall in the purchasing power of your money. Remember when a loaf of bread was $2 and now it's closer to $5? That's inflation in action. If inflation is high, increasing the cash rate could slow down spending. It's all about supply and demand. Less demand for goods and services should make them cheaper, lowering inflation. The RBA likes to keep inflation in a target range, and changing the cash rate is one of their main tools to achieve this. More importantly though, what does this mean for you and your home loan? The cash rate is one of the main factors influencing the interest rates the banks charge on home loans and place on savings. So if the cash rate goes up, your bank may increase your loan repayments every month as they pass this increase onto your loan interest rate. Even a small increase in the cash rate, passed on by a bank to your interest rate, can mean a difference in thousands of dollars of interest over the life of the loan. Let's say you've got a $600,000 mortgage. A 0.1% increase in your interest rate could add about $30 to $60 to your monthly repayment. A small change at first, but over a 30-year loan term, let's just say it's a pretty penny. This would also only apply if you had a variable interest rate. If you have a fixed rate, your interest amount will be the same for that fixed rate term, regardless of what the cash rate is. That is until your fixed rate expires, but that's a future year problem. The other side of the equation is that you may actually earn more interest on your savings, which is good news for those saving for a deposit. This can also work in reverse. If the cash rate is lowered by the RBA, interest rates on home loans and savings may come down. It's important to note that the cash rate isn't the only thing affecting interest rates. There are other factors that banks and lenders consider when applying an interest rate to your loan. Now you know what this means. What can you do other than be that person effortlessly discussing fiscal policy at parties? If you see movements in the cash rate after the RBA has one of their 8 meetings every year, you can speak to your loan market broker to see what this means for your loan and if they can negotiate with the bank to make sure your loan is working in your best interest.